We're glad to have you join us on Tuesday's edition of Business Incorporated. Welcome to the program. I am Bolaji Akinwale. Coming up, Nigeria's Consumer Inflation Index rises to 15.6%. Cocoa farmers are concerned over output as a result of dry winds. Plus, we'll bring you updates on Tuesday's bond markets. Okay, let's begin with the latest data from the National Bureau of Statistics, which shows Nigeria's headline inflation rate has recorded a sharp increase of 1.9% to 15.6% in the month of May. This is the fourth consecutive month that the CPI is recording a relatively strong increase. The higher rate was reflected across all divisions. According to the Bureau office, the rise is attributed to an overall increase in general price level across the economy. The food sub-index increased to 14.9% in May, up by 1.7% from April. And in Asian stock markets, Australia and Japan shares stumbled. But other Asian markets were mixed on Tuesday as investors remained cautious before central bank meetings in the US and Japan, and on uncertainty over whether the UK will vote to remain in the European Union. Australian markets returned to trade after being shut for the Queen's birthday public holiday on Monday. The benchmark ASX 200 closed down 2.06% at 5,203.3, weighed by a 2.19% loss in the financial sub-index, which accounts for nearly half of the broader index. Major Australian banks saw more than 2% losses each, with ANZ shares closing down 2.63% amid shaky investor sentiment across the region. In Japan, the Nikkei 225 closed down 160.18 points at 15,859 after tumbling 3.51% on Monday on the back of a relatively stronger yen. And European stocks traded lower on Tuesday as investors waver ahead of a two-day meeting of the US Fed and global concerns over a Brexit weighed on sentiment. Let's take a look at how the numbers are doing at this time. Ulrich Bat is DWTV Channels TV correspondent. He is live to us from the Frankfurt Stock Exchange. Ulrich, welcome to the program. Concerns over the UK's status in the European Union is being heightened. The markets have come under severe pressure with high level of volatility, with bank stocks nosediving. And all eyes, of course, are on the US Fed meeting, which begins today. What is the expectation of the markets?
Well, the expectation is that the Fed, when it comes to a conclusion of its meeting tomorrow, Wednesday, won't have moved on interest rates. That is, at the moment, people are assuming there will be no interest rate hike this June. That is based on the observation that the labor market in the United States was unexpectedly weak last month. That is, there weren't as many new jobs created as people thought. This would give the Fed, its Federal Open Market Committee, which makes the decision on rates, an excuse not to move on interest rates. Of course, it's not just their concern about domestic U.S. problems. They're also looking at the world economy. They're looking at the oil price, for example, but especially they're looking at the Brexit, the worries here in Europe, and international growth effects that the Brexit would have on all this. And the consensus here in the market is that the Fed, as attuned it is to the world market, let's say in lieu of being attuned only to United States domestic economic data, won't risk moving in this way. An interest rate move is expected in September. That could change as new data, new developments come in as well, though. The Brexit remains, I think, the other main drag on trading here in Europe.
Yeah, absolutely. We'll get back to the oil story in a bit, but let's take a look at German government bonds, which have also taken a hit as a result of investors' apathy and uncertainty in the markets. Is there anything that could upturn this negative sentiment in the market, especially against government bonds, which are expected to be safe havens in times of turmoil?
That's right. I don't think there's anything at the moment that can upset that attitude towards the safe haven character of German government bonds. The yield of the 10-year German government bond turned negative for the very first time in history. The bonds have been around for a long time. They're the major financing instrument for the German government, and they're one of the major investment vehicles for private consumers, but above all for professional investors, not just from Germany, not just from Euroland, but from around the world. Indeed, a negative yield is bad news for investors. It's signaling, it's giving a sign of how negative everyone's estimation is of the economy, but indeed it is an affirmation of the role of a safe haven of a German government bond, because a negative yield means that the price of the bond that it's trading at in the market has shot up so high because of high demand that the nominal interest rate, low at the moment, is not enough to offset that, and so the interest rate, the yield factor goes negative, but it's a reflection of how valued at the moment these bonds are, but it is a sign of trouble overall for the world economy.
Now let's talk oil. Prices have continued to slide. However, the International Energy Agency has declared that it expects the oil market to be balanced in the second half of the year, as the agency revised global oil demand growth forecast upwards. Is this likely to change the sentiment towards oil stocks?
I think that it's a very courageous forecast by the IEA, the International Energy Agency. Anyone who's forecasting the development of oil is taking a lot on, because I think it's almost impossible with the economic developments we're seeing, with the political developments. The Brexit is one issue. The Fed, when it does move, will also have a significant impact on currency situations, on bond prices, on asset allocation around the world. And that all will impact demand for oil and also the assessment of the oil price as a risk factor in the world economy. So I think at the moment it's difficult to say whether the oil price will balance out this year. One must remember, though, and I think the IEA also said this in its statement, oil already has a significant recovery behind it from the low in January, when it was trading below 30 at around $27, $28 to currently just around $50.
Ulrich Bath, DWT, the Channel TV correspondent, thank you very much. And still talking about development in Europe, this time in the UK, where inflation rate as measured by the Consumer Price Index was unchanged in May, 0.3% at 0.3%. Now, the Office for National Statistics says the rate was kept low as a fall in the price of clothing offset a rise in transport costs. The Bank of England has an inflation target of 2%, but has failed to meet this for more than 2 years. Analysts say the low rate of inflation meant it was unlikely the bank would raise interest rates for some time. The office said that the main upward pressure on the inflation rate came from transport costs, which rose by 0.9% between April and May, partly due to higher costs of diesel. Now, the rate of inflation is measured by the Retail Prices Index, which includes some housing costs, rose to 1.4% in May from 1.3% in the month before.